Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me is Mark Marex. He's a specialist with Nasdaq's Index Research and Production Development team to discuss year-to-date performance versus other benchmarks and what sets up Nasdaq 100 companies for future growth. Mark, it's great to have you with us as always. Welcome back to Trade Talks.
Thank you, Jill. Great to be back, and happy Friday to you.
Yeah, certainly happy Friday. Let's take a look at your first chart here as we look at Nasdaq 100 year-to-date performance versus market benchmarks.
Sure. We're about to wrap up the month of May here. Looks like the NDX is up a little less than 5% of the month, continuing what's been really just an incredible streak of outperformance since the market lows in March. Just wanted to give people a quick setup before we move into the next slides to kind of explain, just the disparity in outperformance we're seeing versus other well-known large cap indexes like the SPX, otherwise known as the S&P 500, versus the Dow Jones Industrials, and versus even the Russell 2000, the small caps, ranging anywhere from 15 to 20 to even 25% outperformance on a year-to-date basis. The closest one here really to the NDX is the Nasdaq Composite, which is up 4.4%. A much broader index than the NDX, certainly has a lot more of the smaller companies in it as well. But, again, it's a continuation of a trend we've seen now for really the better part of 10 years where values underperforming growth, especially at the high end of the market cap weighted space. Large cap growth has, if you look at just this year's performance, outperformed on the way up to the market peak in mid to late February, outperformed on the way down, and outperformed in the recovery again. And so I'd like to get into, I guess, some of the fundamentally based reasons for that outperformance. It's not all simply a function of sentiment or technicals as some people like to discuss.
Yeah, and I think if we take a look at your next chart here, Mark, we can see that within sector performance, it clearly isn't just technology, as you had mentioned before.
Right. This is looking at end of year data. We updated this a couple months ago once all the companies were done reporting for 2019. But one of the key takeaways from this is, look, we know that the Nasdaq is the NDX is tech heavy. It's more than 2 times as much tech represented in the index as the S&P 500. We also know that it's heavy in consumer services, and pretty much everything else much lighter than the SPX. Consumer services in some cases having overlap with technology if you're talking about certain firms like Amazon, right? And so what this chart shows you is that on a 10-year perspective, in terms of sales growth, in terms of revenue growth, in our index business's kind of broadest benchmark of large and mid-cap companies in the U.S., technology is a leader, 130% sales growth over 10 years, right? More than doubling. Healthcare, almost doubling. Consumer services, number 3. Not a coincidence that, these sectors have grown their revenues the most over a 10-year period, and that they're also, the heaviest weighted in the NDX. And, it's kind of a self-fulfilling prophecy. We can get into, the other fundamentals maybe on another discussion in terms of earnings and dividends and cash flow, in terms of all those other things. But it really starts with revenues, right? And then the question becomes, well, what is driving the much, much faster revenue growth in these 3 sectors versus everything else? And that largely, it's a function of the economy, right? The economy is shifting away from traditional kind of heavy capital intensive industries like energy, like materials, like your heavy industrials, into sectors that are more dependent on technology, whether it's the technology sector itself or whether it's things like healthcare and consumer services.
All right, and let's take a look at our final chart here, and this shows how Nasdaq-100 companies invest in R&D more so than any other indexes, and that's what really lends to its future growth. And this is actually one of my favorite charts that your team puts out.
Absolutely. For those who are not familiar, Nasdaq does have a small family of indexes that are thematic in nature. We work with a very compelling product partner named that looks at a kind of whole host of different proprietary indicators based off of public filings like intellectual patents, like clinical trials, if you're talking about the healthcare space, government contracts. And so, in this slide in particular, we're looking at patent activity. And we use this for some of our thematic indexes around robotics and AI and other things. But when you look at the NDX, and you look at the overlap of, in 3D graphics, what percent of intellectual patents filed in the last year were by companies in the Nasdaq-100, it was almost half. And this is globally, right? So you're looking at, 35 different disruptive technologies here that we've mapped out. And, you can see that in quite a number of them, the Nasdaq-100 is representing a disproportionate share of global patent activity for these technologies. That's ultimately what drives, new revenue opportunities for these names, and also, has kept them, I think, in a market-leading position throughout the entire year. It's because people are focused on continued innovation-driven growth, and that's what, at essence, you get with the Nasdaq-100.
All right, Mark, great to have you with us as always. Thanks so much for joining.
Thank you.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.